Hello and welcome. You have tuned into In Your Interest here on News 9 Live, and in your interest, we are understanding what's going on with the stock markets again. After a good day yesterday, they're back to their falling ways today. Tough day for the Indian stock markets. Both the Sensex and the Nifty closing 1.5% lower, largely because of a sharp fall in IT stocks. Adding to the pressure were concerns over US President-elect Donald Trump's policy stance and uncertainty about future interest rate cuts in the US. The Sensex falling by nearly 1,200 points to close just above that 79,000 mark, while the Nifty dropped over 350 points to end below that psychological 24K or 24,000 mark. And the pain didn't stop there. The total market capitalization of all BSE listed companies shrank by a whopping 1.2 lakh crore rupees, leaving it at a little over 440 lakh crore rupees. And we're trying to understand and help you understand what to do in times like these when stock markets are seeing a rise, and a fall again. To do that, we have a special guest joining us, Mr. Rohit Srivastava, founder and market strategist, IndiaCharts.com. And joining us here in the studio is Suyash Maheshwari, my friend and colleague. Suyash, let's put things into context. We are just 24 hours ago, we were discussing what a smart recoveries the stock market staged yesterday. Sensex holding on to that 80,000 mark, and we were so proud of how resilient the markets have been. And today, here we are, 1,200 points down on the Sensex.
Certainly, Krishna. Yesterday, remember I mentioned that we have expiry day, so let's not really count on the smart recovery that we are witnessing. But okay, certainly,
we'll give you that, Suyash, that you did have a disclaimer while talking about the recovery markets today. Please go ahead.
Yes, but certainly a rough day for the markets, Krishna. In the morning, I had mentioned that Nifty particularly had to take out 24,350 mark for it to, build onto this rally that we had witnessed in the past 2-3 sessions. And if you look at it on the price charts, 24,345 was a turning point for the market. That coincides with the day's high, and from there we saw a sharp sell-off where the market not only broke this major support that was lying somewhere around that 24,125 mark, but also broke below the psychological level of 24,000 and ultimately ended below it, about 100 points below it. But we are back at those levels where we closed on Friday. So that gap we saw from Monday, that pretty much has gone out. But interestingly enough, Krishna,
before you go any further, there are those green shoots in Nifty, mid-cap and small-cap. Strangely, they are holding up better than the broader markets.
That's what I was getting to, Krishna. The broader markets, they are still they are not ending in the red. At least we have got that. The broader markets, remember, 95% of the Indian stock market is small caps and mid caps, and that particular pocket of the market is not really showing signs of a breakdown from here on. As you also pointed out, both the mid caps and the small cap indices ended flat but with a positive bias. If you look at the overall breadth of the market on a day where Nifty and Sensex gave up 1.5%, the overall breadth of the market is favoring bulls. If you look at it, out of the 2,886 stocks that traded today, 1,550 almost advanced, meaning they went up, and about 1,249 declined. That's a bit of an anomaly in my opinion. But moving on, let's talk about the perpetrators. I think the big the big crash came because of IT stocks.
Yeah.
That index particularly fell by about 2%, and there are two reasons. One, that remember in this crash that we were seeing, rather in the last 1 week, Nifty was down by about 1.5% or so, but the IT stocks, they were doing actually pretty well. They were up by about 3% or so. So some bit of a profit booking was there, and overnight we also saw US retail inflation data coming in, which was slightly ahead of the expectation. So what that did was it has pushed back expectations of a rate cut next year. We may still see a rate cut come December, but next year maybe there won't be as many rate cuts. But overall, if you look at it, the inflation data, of course, that is slightly ahead of the expectations, but we also need to understand that how it impacts the Indian markets. See, if inflation data goes up and if inflation comes ahead of expectation, that really hits the dollar as well as the bond yields. And remember, most of these IT companies, they are exposed to the US markets. A major chunk of their revenues come from those US markets. So if dollar falls, their revenues get hurt. Also, the clients, the US clients may find Indian IT services more expensive. So I think it was a sentimental sort of a pullback that we saw. But Krishna, a big question, was it expiry related woos, or are there more more reasons for the market to fall?
Okay, let's ask that question to Rohit Srivastava, who is with us on the broadcast. Rohit, thank you so much for taking time out to be with us. Talk to us what's going on over here. Is it a lack of enough positive cues? Is it fears and worries over, the fewer rate cut possibility in the US? Or is it just a gestation time leading up to the union budget here in India?
So we have to answer this, question in multiple time frames. There's the big picture scenario, and there's something which is happening in the very, very short term. I mean, today's decline, for example, is part of a short-term bounce that has sort of started, maybe more than a week back. Of course, we've fallen today and, filled the gap that the state elections had created. But overall, I think we still remain in what we should call a bounce mode, where markets are bouncing back from 23,267, I think, odd, where we had bottomed. And possibly this bounce should still continue despite today's sell-off. Today's sell-off, like you said, may be related a bit to expiry. This is probably the first expiry where you will be seeing those additional margins coming in from SEBI on expiry day. So some of those become additional pressure points and cause winding down. So we'll get used to that as well. But I think we are headed back maybe to 24,700 or closer to 25,000 in the next 1 to 2 weeks. The really big question is whether that will be sustainable. And I think my answer is probably not. The reason being everything that we've discussed. We've seen the earnings slow down. The market's been called out for being high on valuation for a long period of time. That has not worked because liquidity was strong. But the earnings slowdown and downgrades is becoming a serious issue. Now, how do we really turn this situation around? While we can talk about the US interest rate policy, which is already pretty much announced that they're going to be looking at multiple rate cuts, and we can go back and forth on data month on month, but at least they have a path ahead of themselves. When it comes to India, we still don't have a clear-cut path, because all we've done is gone from saying that we are aggressive to being neutral on the policy, but there's no real indication of lowering rates in India. And at a time when our currency is close to an all-time low, the chances of cutting interest rates in India stand significantly weakened. So we really don't know whether it will happen now, happen in the next 2 meetings, 6 meetings. It's really a catch over there. So what is really going to trigger the growth cycle in India, apart from maybe some degree of government spending? So apart from that, we don't really have much more triggering growth over here, which narrows you down to a couple of sectors or stocks that might still be doing well because of their own reasons, because of their exposure to certain sectors or certain being export oriented and so on. But other than that, I think we are generally seeing a slowdown in the earnings numbers, which is going to continue to lead to further unwinding of valuations in the market. So this could be a choppy market. It goes up, but you will see further selling in the future.
Yeah, I'm asking that because I'm asking that on a day when the volatility index is above that danger 15 mark. So, what should investors do? How are they supposed to approach, at a time like this? It's the most confusing times to be in. If you're an individual retail investor, watching media and trying to invest.
No, it's a mindset change that is required, because we haven't seen this type of market in quite some time. Everybody's been used to the idea that you just buy the dip and eventually you will see higher prices. And right now, for the first time, I think people are experiencing that stocks that have fallen off a cliff are really not going back to the levels where they were. And that's something to get used to, or start adjusting to. The way around it is that you need to create higher levels of cash. So far, it's been stay fully invested by the dip, but now I think you need to sell the rallies as well, create more cash so that you're actually able to buy at lower prices. That is the basic, outlook that people need to start believing in. That it could take maybe 6 months, maybe 12 months before we get a full-scale recovery, and before we are actually able to lower rates to a point where it actually triggers the next cycle. And till that point of time, having some cash on the side is going to be a good strategy.
All right, Rohit, hi, Suyasha. If I heard you correctly, you mentioned you expect some bit of a pressure in the markets. Maybe perhaps Nifty will go on to test that 24,700 mark. But I have sort of a contrarian view over here. Please correct me if I'm wrong. The foreign institutional investors, they were the big perpetrators of this market crash that we had seen. They had sold about 1.3 lakh crores worth of equity in the last 1.5 months. For them, US markets are shut on account of Thanksgiving. Tomorrow, I think the following day, it's only a half-day trading session. Do you think that we could perhaps see some bit of a pullback in the next 2 days because FIIs will be largely absent?
So you can use that as a technical reason why it actually goes to 24,700 and why you get that rally. But I think there will be more reasons than that. We give too much credit to the FII buying and selling. Yes, it used to be a significant portion of the market activity 15 to 20 years ago. But increasingly with domestic retail and mutual fund participation, I think everyone is well aware that its importance stands reduced because, if you just look at 10 years of FII data, you'll find that 7 years on an annual basis, they were sellers. Then this market should have never come up. So I will not look at their 1 month of selling as the reason why the market really came down, because significantly there has been enough buying also on the other side from domestic institutions. So, and a lot of institutions also sitting on cash, which is coming on month. So cash levels are also high. So if you really want to argue, we can say if the funds decide to deploy that money on the dip, that could be a better reason to say why they will actually go up. But the technical reason is really that there's a lot of short built up in the system. We can view that by looking at the institutional positions. You look at the FII client positions, FIIs are still short by, 1 lakh 20, 30,000 or 80,000 contracts, something like that. It had gone over 2 lakh contracts. It's sort of reduced. They have been cutting back a bit, but it's still meaningfully high. And so there's room for that to happen. In fact, particularly, I'll just mention a stock while we don't really give any advice, but I've put out a chart, on Twitter, and that is of Reliance Industries. What has happened there is the open interest in the stock during this fall. This has been one of the sharpest falls I think we've seen in the Reliance stock in a long time. Has seen the open interest go to a multi-year or multi-decade high, highest since 2006. So what does that really mean? So how we interpret it is if prices are falling and open interest is going up, there's probably been a lot of shorting activity that may have happened in the underlying stock. So these kind of actions are what has been driving the fall. Now what you need is some trigger to drive short covering. So that is sort of what you start looking out for, and moment you get that, then you get sharp rebounds in the market during these phases. The only thing is that when we are looking at a technical bounce and we talk about short covering, we are really not talking about going back to the highs. It's only about releasing some of the pressure that is in the market from traders. And once that is done, then we can sort of go back to assessing it on the slightly medium to longer term basis.
Right, Rohit, I have one more question for you. Right before you joined, Krishna and I were discussing how in a day like this, when the markets, they have cracked by about 1.5%, the broader markets, they seem to be holding, the fort. More stocks are going up than they are going down. The broader markets are looking, both small cap and mid cap indices are also ended, with a positive bias on a day like this when Sensex cracked by about 1,200 points. Does that inspire some confidence?
Yeah, it's been very, very new and unusual because whenever we've seen markets weaken, it's the mid caps and small caps that fall more. But in the most recent correction over the last 2 months, we've actually seen some of the reverse. Every bounce back has seen the mid and small cap indices bounce back much more sharply than the Nifty itself. And that has often given a sign that, maybe things are okay. So, even in the mid of October, when we got the first pullback to 25,000, it looked like the mid caps are rallying pretty strong. And so maybe things are okay. And then the market sold off anyway. So I'm not sure whether they are becoming the giving us the wrong signals, but definitely they are showing greater strength when we simply look at the indices themselves. But when we start looking at individual stocks, we find a lot of them which have been beaten down. So there's probably a divergence. It really requires some more insight and studying as to what has caused the indexes themselves to hold out better than stocks within the mid and small cap. But yeah, that has been true. It gives you hope. But at least in this fall, that hope has not worked at the index level. We've seen the large caps still sell off despite the
Right.
mid caps holding up.
Right. Also, bucking the trend in these markets are, realty stocks, PSU bank stocks, and media stocks as well. Even as the IT and auto stocks continue to get hammered for the day, it was in the PSU banking pack and the real estate pack that held well, even at a time like this.
Yeah, so I wonder if that's to some extent, there's a lead lag effect when it comes to reality. Real estate continues to do well a little longer than equities, but eventually, if equities are weak, then real estate also gives up. So that is one angle of looking at it. The other is that more speculative in nature, because what you would expect in this type of an environment where earnings are weakening is that money would go into defensive stocks or sectors, which means you would be buying pharma, IT, and so on. But instead, you're actually seeing things like media, which are more speculative, moving up. So it's not exactly a good sign, but that is what it is.
Rohit, I just have one more question. We had Gaurang Shah and Kranti Bhatini over yesterday. They told us that, even when the market was cracking, their investors or the clients were asking, where do we park money? They were not worried about the market crash, so to say. What are your clients asking you?
No, people are still optimistic because of the cash levels. That is the sense I get. Because the cash levels are high with mutual funds and the liquidity is still coming in, everybody expects that at some point of time the buying will support the market, and therefore it's not going to fall too much. So let's look for some opportunities. But my sense is that you are starting to see a very broad-based weakening of the market. And this is happening because of the earnings slowdown and lack of visibility over the next 1 to 2 quarters. That is now showing up in various numbers that analysts are putting out. And that's concerning. Till we can actually get clarity on the earnings cycle, it will become very, very difficult to justify the levels of the market. So that's
Right.
the catch.
That's the catch, says Rohit Srivastava, founder of market strategist, IndiaCharts.com. Rohit, as always, a pleasure talking to you. Hope to keep having you on the show again and again. But for now, we've completely run out of time. Thank you so much for joining us. And with that, it's a wrap here on this edition of In Your Interest. Thank you so much for watching. This is Krishna Kumar signing off.